Welcome to the online financial school. We continue our skills development using cost-effective delivery platforms. This recording deals with term assurance products. These are insurance products, and the objective of this lecture is to develop an understanding of what are term assurance products, what kind of benefits do they cover or offer, and who would be interested in term assurance products. So if you're looking at term assurance products as an insurance product, you are looking for the most part at a protection product. In terms of protection, there is almost no savings element on these products. They are fixed term products which expire. So you can take a 5-year policy, which means that you get cover for 5 years, and after 5 years the cover expires and the policy stops. You stop paying premiums and there is no more cover. Or you can have a 10-year policy, or you can have a 20-year policy, but it's a fixed term policy. The sum assured on these policies is paid if you die during the period of cover. In other words, within the 5 years or the 10 years or the 20 years. If you are covered, then the policy will pay. Otherwise, if you don't die within that period, the policy does not pay. This is a very cheap form of insurance, which unfortunately does not pay any maturity value. It does not pay a surrender value, which makes it very difficult for people to understand, because it asks you to pay for an intangible, that is cover, which you cannot touch. So it's a difficult thing to sell. It is used by parents of young children during the minority of the children. So the risk that is being covered there is the fact that if the parents were to die before the child reaches adulthood, then the proceeds of the policy can be used to look after the child, can be used to pay fees, can be used to buy food for the child. So in this case, you are looking at a policy that will pay a sum assured for death in a given period. The premium may actually be paid throughout the policy term, or it may be paid as a lump sum upfront. There are other applications of this policy. If you look at business, there's something called key man insurance in business. So let's look at a business partnership. If one partner were to die, then this could disrupt business, it could reduce profits, and cause all sorts of problems for the business. So you take a policy on the life of the key partners. Similarly, for highly qualified professionals, if they were to die and it disrupts business, you can take a policy on their lives. There are 3 types of term assurance, and they differ in the application. They also differ in terms of what they are suitable for. So if you are looking at, for instance, term assurance, the first type is the so-called level term assurance, which is basically a level amount of cover, which means that over a 5-year period the cover is fixed. It doesn't vary. Or if you're insured for 10 years, then the cover is 1 million over the whole 10 years. If you die in 10 years, then the cover will be paid. Decreasing term assurance. This is a policy which starts off maybe at 1 million, goes to 900,000 in the next year, 800,000 in this next year, and so forth and so forth. Actually, looking at this policy, it's one of the policies that is very suitable for covering children during their minority. In other words, parents can use it to protect their children. Increasing term assurance. This is a policy which increases over time. So if you start off at 1 million, the policy could go to 1.2 million in the second year, 1.4 million in the third year, and so forth and so forth. So in this policy, there is an increasing cover. These policies, if we could start, have got very, very strict underwriting conditions, because in this instance, what is happening is you are getting a very high amount of cover for a relatively small amount of money. So you will be required to undergo underwriting in order to ensure that you are healthy and you don't bring unnecessary risk to the insurance company. It's risk pool. So the first thing that may be required of you is a medical declaration if the sum assured is not too high. And depending on the sum assured, you can be asked all sorts of questions about your medical history, your current medical condition, and so forth. If the sum assured is slightly higher, you will then be asked to go through a medical examination which looks at things like blood pressure, the condition of your heart, your heartbeat, the normal basic medical examinations. Things can get even more serious if you are taking a big policy, for instance, for $1 million, $20 million. Then you could be asked to go for blood tests. You could be asked to go for an ECG, or you could be asked to go for an X-ray, chest X-ray. The greatest risk when it comes to these policies is anti-selection, which means that the insurance company is very keen to ensure that they take on lives that are healthy. They avoid people who have serious health conditions. Similarly, that the insurance company is able to keep people who are healthy on its books so that they do not surrender their policies. Insurance companies only make money when they insure healthy lives. Otherwise, it's a struggle.